I'm excited to be joined today by Ryan Ackers, Vice President of Business Development at Harbourfront Wealth Management and one of Canada's experts on individual pension plans and retirement compensation arrangements. Previously, Ryan held the position of Vice President, Business Development and Client Relations with Gordon B. Lang and Associates, Canada's largest provider of IPPs, RCAs, and fair market valuations of life insurance. Over the years, he has counseled a wide range of professionals, board directors, corporate executives, business owners, incorporated professionals, professional athletes, to name a few, and has helped their families implement various specialized tax strategies. Ryan, thank you for joining us today.
Thanks for having me, Wes. It's great to be with you.
So before we jump into how you've helped Canadians build wealth and save tax, why don't you tell us a little bit about yourself and background?
So I joined Harbourfront Wealth Management earlier this year. As you mentioned, prior to that, I was with Gordon B. Lang and Associates, or GBL, for several years, where we helped grow the IPP and RCA presence across Canada. Before that, I worked with a Big Five bank, where I got my feet wet in the industry. Grew up in a small town in Ontario and lived in Toronto for 10 years before I moved out to Calgary in 2014.
Thanks. So today we're going to focus in on one of the items I previously mentioned, specifically the individual pension plan, or IPP. We generally describe these as beefed up RSPs, or as what you've said before, a supercharged RSP for business owners, executives, and incorporated professionals. Ryan, what do you think is driving Canadians to look into these specialized tax strategies in more detail?
Well, that's a great question, Wes. There's quite a few things that have changed since the time that I joined GBL before I came over to Harbourfront. We've seen tax rates increase considerably for business owners and incorporated professionals. We've seen a lot more uncertainty in the markets and in the economy in general. And if we look at the slide that's pulled up right here, there's a lot of worry in the business community about further tax increases. So COVID-19 was a big driver of IPPs and RCAs, because business owners tend to be a bit worried that tax rates could increase further. As we see here, Canada's parliamentary budget officer said that our deficit isn't sustainable, and COVID really supercharged that deficit. So we have that the business owners are worrying about. And more recently, we've been really focused on inflation. But we have to remember what happened before this inflation crisis that's happening. So we've seen those tax rates increase for business owners. We've seen a lot more uncertainty, and now we've got inflation that's at the highest it's been since the 1990s. So there's a lot of things that are working against business owners' favor. And just to give you an idea, prior to COVID and the inflation surge, we've seen a bit of a story that's played out over the past 6 years. So in 2016, we saw some major change to tax policy across Canada, notably 50.67% tax on investments, the elimination of the multiplication of the small business deduction. So you've got a lot of business owners who might have partners, or they might have multiple businesses. Essentially, they used to have their own small business deduction for each entity, and now they have to share that amongst each other. So if you've got, let's say 10 partners and you had a $500,000 small business deduction, you have to share that amongst the 10 partners. So your small business deduction is reduced to $50,000. And then income integration. So around 2016, 2017, we saw a bit of a switch in how business owners pay themselves. So dividends in the 2000s and 2010s were pretty popular as a way of remuneration, but we saw integration of tax rates between T4 and dividends, which led a lot of business owners to move back to T4. A benefit of that is they get to take advantage of some powerful tools such as RSPs, IPPs, RCAs, health spending accounts, things like that with T4. Fast forward to 2018, and we saw some major change for business owners then. So TOSI, tax on split income. So essentially, if you've got a business owner who has a family and those family members are earning income from that business, there's a lot more scrutiny that the family member who's an employee has to be earning a fair wage for a fair amount of work. So that's hit family planning pretty hard. And then the taxation of passive income, or the small business deduction grind. So this led to a big increase in IPPs and RCAs from 2018 to now. Essentially, what the government said was, we're going to establish a border as to what we deem to be too much income in your corporation and not too much income. Now, that border is $50,000 of passive income. So if we reverse engineer that number, we look at maybe $1 million invested in the corporation at a 5% return. Might be a little bit trickier to do this year, but in previous years that was pretty reasonable. That's your $50,000 of passive income right there. So for every $1 you exceed that $50,000 of passive income, your small business deduction gets clawed back by $5. So as you can see, tax policy hasn't been favorable for business owners. And now that we're in a COVID environment and an inflationary environment, there's a lot more uncertainty. And I'm not even going to go into 2022 plus or 2022 and ahead, because we've got some other changes that have been discussed over the last few years that could happen as well. So just a recap of what worked then and why it doesn't work now. We discussed most of these in the last slide, but saving for retirement inside your corporation, that doesn't work as well anymore because we've got the taxation of passive income and we've got exposure to creditors. Payment of dividends, we talked about that on the last slide, income integration. And then finally, flowing money out of the company through family members, that's TOSI that we talked about in the last slide. So not the prettiest picture that we've ever seen for business owners, Wes.
Yeah, it's somewhat of a bleak outlook for them. So tell me, like, outside of traditional savings such as RSPs or saving through a corporation, in other words, retained earnings and not drawing it out until a later date, why would Canadians consider an individual pension plan?
Well, the individual pension plan is considered to be one of the last few remaining products that business owners can use to help protect themselves from these changes that have happened. So it's really helping them not only build a pension for themselves, but helping to get some more deductions for the corporation. So what is the IPP? It's a supercharged RSP. That's what we like to call it here at Harbourfront, and I know the actuaries like to call that as well. But we call it a supercharged RSP for business owners and incorporated professionals. We're using the richest benefit formula in Canada to calculate contribution room for this plan. We can index to inflation, which wasn't a huge driver of IPPs over the last 6 years, but this year it most certainly is. And it just helps to get more deductions for the company and put away more money for retirement. So I'll start off with the ideal IPP candidate, so the who, and then I'll discuss the what. What does the IPP do? So our ideal candidate earns T4 income, and we've got our rationale here on the right. If you could just read along while I go through the criteria. So we look for somebody who earns T4 income, who has a business or is an incorporated professional, and falls between the ages of 38 to 71. And I'll get to that shortly on why we talk about that age range. And then a bonus criteria that isn't required for the IPP, but shows that the IPP is going to add a lot of value, is if there's strong cash flows in the corporation and a need for tax sheltering. So this is the ideal candidate for the IPP. If anybody in your audience fits these top three criteria and has this bonus criteria potentially, then you might want to talk to Wes and his team about an IPP and if it fits for you. So that was the who. Here's the what. So what does the IPP do? I like to break it down into 4 categories. This is how the pieces of the puzzle fit together. So we can supercharge your retirement savings. We talked about that on the first slide. So you can just put more into the IPP than you can with a traditional retirement savings vehicle, such as the RSP. I'll get to that on the next slide. We mitigate risk. So the assets in the IPP are held in trust off the corporate books. So you have less money in your corporation that's exposed to creditors. This was a big driver of IPPs throughout COVID. Just an example would be, but imagine being a dentist who has an office in a downtown core when nobody's allowed to go to work because of the pandemic, or very few people are allowed to go to work due to the pandemic. And then you've got people who are losing their benefits because they're getting laid off. Pretty scary time for a lot of professionals and business owners. So this creditor protection and risk mitigation was a big driver. Corporate tax deductions has been a big driver for IPPs for a long time. Business owners have had a need for corporate tax sheltering, and this is a good way to be able to do it. And finally, estate planning. So this doesn't apply to everybody. It really applies to family businesses. If we have a family business where, let's say, the two parents and the kids all work for the company. Let's say the parents decide they want to retire in a few years, and the kids have been a member of the IPP and the parents have been a member of the IPP for a few years. Parents retire, start drawing down their income while the kids are still contributing to the IPP, working for the company. Let's say the parents pass away. There is no taxable disposition on death of the last parent. That money stays in the IPP until the kids are ready to retire, and then they pay tax on their withdrawals. They pay tax on the income they draw down from the IPP. But they bypass that estate tax that typically happens with an RRSP or with a non-family business IPP. So that's how the pieces of the puzzle fit together. I'll go really quickly through this, but we talked about the supercharged retirement savings. So with an RRSP, as you're aware, you can put 18% of your earnings into it every year up until age 71. Doesn't matter how old you are. With the IPP, you can put a higher percentage of earnings into it every year, right? So we see that here. So that RRSP contribution stays exactly the same no matter how old you are, while the IPP contribution goes up over time as you get older. You know, we could have potentially as much as a 69% increase in what you can put into an RRSP versus an IPP. That's 29K versus about 20K. So that's same concept as an RRSP. Depending on how much income you earn, that's how much you can put in this year and in future years.
I know you're going to be going through some examples here, but just on the surface, really quickly before you get into them, you know, not only is there some estate benefits, there's risk mitigation, but it looks like there's a significant benefit on the tax side and the ability to sock away more money than in traditional RSPs.
Absolutely. Yeah, you can put a considerably higher amount of money into the IPP in almost every case.
Okay.
Yeah. And we saw that on the last slide. So for current service, and we also see that on this slide as well for past service. So same concept as with an RRSP, where if you ever look at your notice of assessment and you see that unused RRSP deduction limit section, we have that same concept with the IPP, but as our friends at the actuarial firms like to say, they supercharge that. So depending on how old you are and how long you've worked in your company, you could have potentially $1.3 million in past service in addition to your current service as well. So this is a pretty big deduction, and it's a great way to pull quite a bit of money out of your company, tax shelter it, have it there for your retirement, and also have it creditor protected as well. Now, when we set up the IPP, we also move a portion of the RRSPs into it as well. Now, that's a CRA rule, but I'm going to get to a benefit of that in the next couple of slides. One benefit of moving RRSPs in is that in order to take advantage of past service, we have to move some RRSPs in. So as you can see here, there's a pretty big benefit to doing that. Now, we also have, and it goes on, we also have the ability to top up the IPP at retirement. So you get some extra benefits at retirement that you see here, and you also get typically a nice tax deductible lump sum that can go into the IPP at retirement as well. So that's another deduction for the corporation. And we talked about the creditor protection, the risk mitigation, and all that. So just to summarize, before we get into the examples, we're going to go over the corporate tax deductions now. So everything that we've talked about, current service, past service, terminal funding, and one thing that I skipped over that I can just talk about really quickly right now is top-ups. So the IPP has an assumed rate of return of 7.5%. That's a bit outdated these days. That assumption was put forth back in 1991. So if the assets in the IPP don't grow at 7.5%, you have the option, but not the obligation in most provinces in Canada to make that top up to fund that difference. So let's say you've got a portfolio that gets a 5% return. You can top up that 2.5% shortfall between 5% and 7.5% with additional tax deductible dollars. Now, like I said, in most provinces in Canada, this is not enforced, including BC, Alberta, and most of the provinces. There are some provinces where you have to make that top up, but just Saskatchewan, the Territories, and some of the Maritimes. Okay. If you're in Ontario, no payroll taxes. Now, we can also deduct the fees as well. So you can deduct the actuary's fee. So typically the actuary is going to charge about $1,500 to $2,000 to run the IPP every year. So assuming that your corporation is around that 25% tax rate, which is average in a lot of cases for IPP clients, that's 25% off that $2,000 at tax time. So $500 essentially comes off that $2,000 during your tax return, right? So your fee is effectively down from $2,000 to $1,500. Advisor fees are also tax deductible as well. So for RSPs, you cannot deduct advisor fees. With the IPP, you can. So depending on what the advisor fee is, that's another deduction that you can get that gets you some more benefit with the IPP.
And again, I might put you on the spot here, but I see there's significant tax benefits. There's a way to supercharge your retirement planning, the ability to go backwards. I don't know if you have this statistic off the top of your head, but how underused are individual pension plans out there in comparison to what they could be doing?
That's a fantastic question. So to give you an idea, there's more than 1 million business owners in Canada. All right. IPPs, there's about 13,000. So when you look at business owners and incorporated professionals, that includes doctors, dentists, lawyers, accountants, and then all of your business owners. So it could be a transportation company. It could be a media company. It could be a wealth management company. 13,000 IPPs exist across Canada. So to your point, they're extremely underutilized.
And why do you think that is? What do you think is the key driver of the lack of IPPs across the country?
Education. And I've said this many times before, but Harbourfront advisors have been ahead of the curve on IPPs for a long time. Not every firm has advisors who are that committed to understanding what the IPP is, because a lot of work goes into understanding it and then being able to educate your client on that and not, for lack of a better term, not kind of mess up as you go along, right? So it's an education issue for sure. Once advisors and accountants and business owners and incorporated professionals understand what the IPP is, typically they're on board. It's just getting them to that point. Second reason is because tax policy changed. It's changed over the past few years. We went over a slide about what happened since 2016, but there are still some individuals who just don't recognize the IPP as a solution for those changes.
Great. Thank you, Ryan.
Absolutely. That's a fantastic question.
This is great, Ryan. Why don't you walk through a couple of examples to give our audience an idea of the power of the IPP and what it looks like over time for individuals that are implementing them?
Absolutely. So we have 3 case studies that we can run through today. So case study 1, a pretty typical case with an IPP. We have a medical professional corporation, so a doctor. This doctor has had their business for 10 years. The doctor is 55 years old. They've got employment income of $171,000. So $171,000 is what we call max earnings. So that's the amount of income you have to earn to be able to maximize your IPP contribution and your RRSP contribution each year. This amount tends to go up every year with the CPI, but sometimes it can go down as well if there's a recession. And then they have $260,000 in RRSPs. So what would this IPP look like? So we have a contribution comparison. So if we look at year 1, for anybody in the audience who's watching, just kind of think about why year 1 might be so big. And in the meantime, I'll go over every year thereafter. So you'll notice that the IPP not only exceeds the RRSP for contribution room, but that contribution room for the IPP speeds up and the RRSP doesn't speed up as much. That's because you can put a higher percentage of your earnings into the IPP every year. and the RSP stays flat at 18%. Now, going back to year one, as you probably guessed, we include both current service and past service in year one. That's why it's such a bigger year. But if we just ignore year one and look at every year thereafter, just to be conservative, if we chop off where the red meets the blue and stack that up, that's a pretty big difference in contributions over that 9-year period in this case, because we're omitting year one, right? So this is our contribution comparison. This is our total savings comparison. So we've got the difference of about $1 million versus about 1.675 million at the end of that 10-year period. That's a pretty nice difference over 10 years.
And Ryan, you're assuming the same growth rate on this example. The difference is simply the tax savings and also the contribution, past service, and future amounts that you can put in, correct?
So we're actually not even including the tax savings. So that's completely separate. What we're including is just the contribution room and the growth. So we're assuming the same amount of growth. So here's our contribution room here. We're assuming the same growth percentage for both the IPP and the RSP, even though the RSP doesn't give you the ability to top up 7.5%. We're still doing an apples to apples comparison. So all this shows is the contribution and savings difference. It doesn't show the tax deductions for the corporation, which is another side of the story.
Yeah. Which can be significant over time as well. So I'm happy we identified that, because for a lot of business owners or professionals and incorporated individuals, it's really about managing that tax, which is critical. So not only does it provide, again, that supercharged or beefed up savings plan, but also the tax deductions along the way, which actually gets you that much further ahead.
Exactly. This is a really conservative example because we're not including that, right? To your point, those tax savings. And that's a big part of the benefit to the IPP. So I have another example here, 2 more examples, but this is just a business owner case study. So we've got wife and husband. The wife owns the corporation. She's had it for 5 years. The husband earns some employment income as well. So she's earning 150K. He's earning 50K. We've got 160K of RRSPs combined. What could this IPP look like? Well, here's our contribution comparison. And this is meant to show, sometimes we get asked the question, why would we set up the IPP when we're younger? Why wouldn't we wait until we're older? This shows that it really makes sense to look at the IPP anytime between the ages of 38 and 71, right? So this is our contribution comparison here. Total savings comparison. We've got, depending on what year they retire, it could be 3 million versus 1 million at age 60 if they retire then, or it could be potentially 4.4 million versus about 2.5 million. Now you'll notice there's an extra bar here on this one. So we have the red IPP bar, the blue RRSP bar. Earlier on, we talked about that top up that you can do at retirement called terminal funding, where you can get a deduction for the corporation and some extra benefits throughout retirement. This is the terminal funding top up. So the younger you are when you set up the IPP, typically the larger your terminal funding is going to be, right? So it just shows the benefit of setting up the IPP anytime between the ages of 38 and 71.
Again, I think these examples just show the power of these advanced tax strategies for Canadians, that it might make sense. And for a lot of them, as you mentioned, they just don't know what they don't know. And really, it's just starting to have that conversation to see if any of these apply to them. So here's what I'm hearing thus far, and I'm just going to try and chime in if I've missed any. So again, there's tax savings, there's the ability to sock away more money, so the additional savings over the lifetime plus past, and then as well there's some estate benefits where if you actually have a family working together in a business, including the kids, it's a way to bypass the estate, which can be quite significant for RSPs, and actually pass that down to the next generation. So the benefit is actually you're deferring that significant tax amount, which can be as much as 53.5% here in BC. You can defer that to the next generation for another 30, 40, 50 years. So again, you talk about 13,000 IPPs out of all the businesses out there. I just don't know why more people aren't exploring these. And again, it comes down to education, but I think this is great with what you're showing. So last couple questions here. Tell me a little bit about the setup process, the timelines. You talked a little bit about it earlier. You have to get an actuary involved. It takes a little bit longer. But yeah, tell us a little bit about how that works.
Absolutely. So we would have to have an actuary involved. So they're the ones who calculate the allowable contribution room and make sure that the IPP is on site with CRA and the Ministry of Finance. So the actuaries are there to not only make sure that you're getting the benefit of the IPP, but also protecting you to make sure that everything's on side. So the timelines, just to go over briefly. So to set up the IPP, there's a couple of stages of registration that happen. So there's deemed registration and full registration. So let's say you'd like to move forward with an IPP. We would complete an illustration. So we'd reach out to an actuary, get an illustration, make sure that it makes sense. If it does, then we'll go through the setup process. So the actuary will collect some information. They'll then submit that information to the CRA. And typically about 6 weeks after it's submitted, you can expect CRA to write back with what's called deemed registration. So deemed registration is CRA acknowledging that they've received the application and that they're going to do a further review. But at that time, they assign a registration number that allows for you, Wes, to open up the investment account for the IPP. And it could be partially funded at that time if you like. Now, the full registration or final registration typically takes about 3 to 5 months. And that's the process of which CRA goes through, verifies that the information is accurate. And once they provide their approval on that, the IPP is considered officially set up. Important point, IPP contributions can be carried back 120 days after corporate year end, not the standard 60 days roughly for an RRSP. So if you have a December 31st corporate year end, for example, you've got until the end of April to make that contribution and get the deduction for that year. As you see here, COVID has slowed CRA's processing times. So that's something we have to be wary about as well.
Excellent. Thank you, Ryan. Earlier I talked a little bit about RCAs, and I don't want to really get into it today, but maybe this is for another call. But can you just give a little bit of information or points about RCAs and who they might apply to, or what their benefits are?
Absolutely. So if you were excited when I mentioned that the IPP is like a supercharged RRSP, I know how people get really excited about that. The RCA is like a supercharged IPP. So the RCA, which we can go into more detail perhaps in another discussion, is a tool that can be used. It's been around since the 1980s and can be used to essentially shelter larger sums of money than what the IPP will allow. So we see the RCA used in typically 3 cases. Number one, if you set up an IPP and you're looking for some more contribution room than what the IPP can provide, we can build an RCA on top of that IPP. Number two, if you're looking for more flexibility. So for example, if you're not a business owner and your company wants to set up a plan for you, well, the IPP is really meant for business owners, and the RCA works for both business owners and non-business owner employees. So we can set it up in that case. And number three, it's good in cases where you're going to come into a large sum of money, such as a big bonus or a severance payment, or potentially the sale of a business. We can set up an RCA. We do a lot for NHL players as well. So that's just a brief teaser on the RCA. If the audience is interested to discuss it later, then I'd be happy to discuss it at a later time.
Excellent. Well, listen, Ryan, thank you for your time today. We'll definitely have to do this again in the not too distant future and dig into the RCA. In the meantime, I wish you all the best. Like I said, thank you for your time today. And I know this information is going to be both valuable and well received.
Well, thanks for having me. It's always a pleasure. And let's boost that 13,000 number to 30,000.
Fantastic. Have a great day, Ryan.
Thanks, Wes. You too.